Chamber has done impressive work over the years to strengthen the local business community and economy here in Guelph, and I'm sure it has contributed to Guelph having one of the lowest rates of unemployment in the country, and that's an outstanding achievement, and I'm sure the Chamber is proud of that accomplishment. Now, economic vitality needs to be nurtured, which is what the members of your organization have been doing since 1827, when Guelph was little more than a gleam in the eye of its founder, John Galt. Galt never succeeded in establishing a bank here in Guelph, but early residents created a building society to help them save and borrow for their farms and businesses. That society supported the economic development of Guelph. My topic today is the financial system in Canada that emerged from those modest beginnings in Guelph and other communities in Canada, and the role the Bank of Canada plays in helping to maintain its overall stability. I'll also talk about an important threat to financial stability in Canada, elevated household debt. Like the transportation system, the financial system is essential infrastructure. It provides core functions necessary to facilitate economic activity. And it is constantly evolving, incorporating new technology and other innovations to become more efficient. It is as vital to the economy as our system of roads and highways. Although the Bank of Canada is not responsible for directly overseeing banks and insurance companies, we help to promote financial stability and efficiency in a number of different ways. In these efforts, we take a system-wide perspective that encompasses all Canadian financial institutions and markets, especially those that we call systemic, or in other words, critical to the functioning of the entire system. This system-wide perspective allows us to connect the dots, not only across the financial system, but equally importantly, between the financial system and the real economy. By seeing how all the components work together, we can identify potential problems before they become serious and help to maintain the flow of financial traffic. An important vehicle in our effort to promote financial stability is the Financial System Review, which we publish twice a year. The review summarizes the bank's analysis of the main vulnerabilities and risks to the stability of the Canadian financial system. Its purpose is to inform both the private and public sectors of our assessments so that they can take appropriate steps to mitigate these vulnerabilities and reduce their exposures to them. In 2014, we incorporated into the review a new framework for identifying, engaging vulnerabilities, and assessing risks. In my talk today, I will cover three main points. First, I'll begin with an overview of this new framework. Second, I will show you how we apply this framework. To do that, I'll take you through our assessment of the vulnerability that high levels of household debt pose to the financial system. I'll draw on recent bank research into the increasing prominence of highly indebted households. And third, I'll briefly discuss the bank's contribution to reducing vulnerabilities. Let me begin with why and how we assess risk to financial stability. The better we understand the sources and transmission of financial system stress, the better we are able to prevent or at least limit the impact of financial crises. To that end, our new framework informs and directs our risk assessment process. At the heart of the framework is the explicit identification of vulnerabilities and risks. Such transparency encourages everyone involved in the financial system to consider how to mitigate vulnerabilities and react if risks were to materialize. Now, our framework sets out three steps, and I'll go through each of these in turn, and the steps are shown on the slide here. The first step is identifying vulnerabilities or weaknesses, which are conditions that could amplify or propagate shocks throughout the financial system. Examples of potential high vulnerabilities include high levels of indebtedness or leverage, and the mispricing of assets such as houses. In contrast, risks are events or outcomes that could threaten the ability of the financial system to perform its core functions. Risks materialize when trigger events, which are adverse shocks such as the recent dramatic drop in oil prices, interact with vulnerabilities. To illustrate the difference between a vulnerability and a risk, imagine a bridge with fractures in its concrete support. That's the vulnerability. The risk is that the bridge could collapse if a trigger event, such as an earthquake, shook its foundation. Focusing explicitly on vulnerabilities in the Canadian financial system allows us to highlight where the fragilities lie and how they are evolving. We identify a range of vulnerabilities and consider them in relation to a wide variety of financial institutions, markets, and users and payment systems. So here's the table that we use to sort of monitor vulnerabilities in the Canadian financial system. Along the vertical column, we have different components or different sectors of the financial system. And then across the top, we have different types of vulnerabilities. And within each cell, we have different indicators to measure the degree of the vulnerability. And today I'm going to focus on elevated household indebtedness, which represents a high degree of leverage in the household sector, and that the household sector sits in the non-financial sector for the purposes of our analysis. Now, the second step is developing a risk scenario for the most serious vulnerabilities, including a list of possible triggers. A risk scenario describes how a trigger event will interact with a vulnerability to affect the financial system. I'll give you a concrete example of such a vulnerability in a minute. Third, we assess the probability of each risk taking place and the impact if it did occur. That, in brief, is our framework. Now let's look at high household debt. As you know, Canada was spared some of the most serious negative consequences of the global financial crisis. That's largely due to our strong financial, regulatory, and supervisory framework and the effectiveness of our policy response. This response included a reduction in the policy interest rate by the Bank of Canada to support aggregate demand to help achieve our 2% inflation target. As a result of these policies, the Canadian economy recovered relatively quickly. That recovery was supported by solid growth in household spending that was funded by household income growth and also borrowing. The buildup of household debt, however, has increased the vulnerability of the economy and the financial system to adverse shocks to incomes and interest rates. More household leverage implies less household resilience. For example, during times of stress, people who are deeper in debt will typically cut back more on their spending. This means that high household indebtedness can amplify the impact of an adverse shock to household income. In more extreme cases, such a shock could lead to an increase in household defaults, which would mean losses for banks and other lenders and mortgage insurers. In the worst case, if the losses were extensive and the spillovers were large, the capital or equity buffers built into the financial system could become depleted. This outcome would impair the system's functioning, with large negative effects on economic activity. To understand the magnitude of this potential threat to the financial system, we need to understand both the sustainability of the household debt and the impact on the financial system of increased defaults should they occur. That raises three key questions. One, which households are holding the debt? Two, how likely are the highly indebted to lose their jobs? Three, how able are the highly indebted to service their debts? So who is holding the debt? The quick answer is that the debt, which has increased over the last 12 years, has become more concentrated in the hands of the younger, less affluent, and more vulnerable households. Now let me give you some background detail. We know that household debt has increased significantly over the last decade. In particular, the debt held by highly indebted households, those with gross debt to gross income ratios greater than 250%, increased by almost 75%. Within this group is a subgroup of the most highly indebted households, defined as those with a debt to gross income ratio of more than 350%. And you can see the evolution of debt in this graphic here. And so what we've looked at is the volume of debt in sort of inflation-adjusted dollars from 2002 to 2008 and on to 2014. And the lighter shaded area is households with debt levels of less than 250% of gross income. Then the more darkly shaded is over 250% but less than 350, and then the most darkly colored is the 350%. And you can see that as you move from 2002, 2008, and 2014, the debt increase that we've seen in Canada is largely concentrated in those highly indebted households. And in particular, when you look at the darkly shaded areas, it's mostly those households towards the lower end of the range, which are younger households. Now, the size of this subgroup has doubled from around 4% before the crisis to around 8% today. That amounts to 720,000 households holding close to $400 billion in debt, about 1/5 of the overall household debt in Canada. These highly indebted households are also more likely to live in British Columbia, Alberta, or Ontario, provinces where house prices are highest. And in the graphic that you can see this in the next graphic here, where we've got the number of highly indebted households per 100,000. And we've looked at two periods. The blue one is the period just before the crisis, and the red one is more recent data. You can see that in British Columbia, Alberta, and Ontario, the size of that red column has increased fairly significantly over the last 10 years. Now, these households are more likely to lose their jobs because they tend to be younger and are less likely to have a post-secondary degree or training. How able are they to service their debt? Our analysis suggests that highly indebted households are vulnerable to interest rate increases because of their high debt-to-service ratios. They also have limited savings to service their debts should their incomes decline. Despite their high debt loads, Canadian households are still in much better shape than their U.S. counterparts were at the start of the financial crisis. In particular, they are less indebted and have lower debt-to-service ratios. And you can see this in the table. And for example, the second line shows the proportion of indebted households with a debt-to-income ratio of above 350%. And you can see that percentage was virtually twice as high in the United States before the crisis than it is in Canada now. Now, even within this subgroup, in the United States, the numbers, the percentage of, the proportion of households in this subgroup that had debt service ratios at or above 40% was essentially double what it is in Canada. So that indicates that our households that are highly indebted are much less vulnerable than similar households were in the United States before the crisis in 2007. Let's now consider a plausible risk scenario associated with this household debt vulnerability. A number of triggers could set off the risk, but the most plausible is a severe recession that causes a sharp, widespread rise in unemployment, which reduces the ability of households to make their payments on their debt. To gauge the effect of such a shock on the stability of the financial system, we simulated a large and persistent increase in the unemployment rate of 5 percentage points. To be clear, the probability of such a scenario is low. Nonetheless, our simulations suggest that in response to such a shock, the rates at which households fall behind on their payments could rise significantly. We estimate they could rise from less than 0.5% to almost 2% within 3 years. A substantial portion of this estimated rise would be attributable to the increase in debt and its concentration among highly indebted households since 2007. What are the implications for the financial system if this vulnerability were triggered? A rise in household arrears could force some vulnerable homeowners to sell their homes or eventually default on their mortgages and other consumer debt. If defaults rose quickly, or if many households were forced to sell their homes, house prices could drop sharply across Canada, particularly in Vancouver and Toronto, which have recently experienced exceptionally strong price growth. A broad-based decline in house prices would in turn have direct effects on Canadian lenders and mortgage insurers. The results from stress tests, however, show that there are sufficient buffers in the financial system to withstand such a scenario. The big 6 Canadian banks have increased the quantity and quality of capital in recent years and are well diversified across regions and sectors. In addition, most of the mortgages they hold are supported by government-backed mortgage insurance programs or by high levels of homeowner equity. Nonetheless, if a widespread decline in house prices occurred, the impact on the broader Canadian economy and the financial system would be significant. Despite the drop in the price of oil and some other non-energy commodities, the probability of this risk being triggered remains low. The decline in commodity prices has set off a complex and lengthy chain of adjustments within the economy as capital and labor shift between the resource and non-resource sectors. The negative impact of this shock has been felt most acutely in the oil-producing regions, where employment insurance claims have been rising. The non-resource sector, however, is expected to gain further traction, supported by the strengthening global economy, most notably in the United States. And we see some of those positive effects here in Guelph. The stimulative effects of a lower Canadian dollar and accommodative monetary and financial conditions will also help. Indeed, the bank's interest rate reductions in 2015 helped to reduce the probability of this risk materializing. Despite the low probability, the bank assessed this risk as elevated because of the large potential impact it would have on the Canadian economy. And this graphic here gives you a sense of how we assess risk. So really there are 2 dimensions in our assessment. One is the probability, which is along the vertical axis, and one is the impact if the risk were to occur. And so in the case of this scenario I just described, the probability is relatively low, yet the impact if it were to occur would be relatively high. And so that's why it's in the lower bottom cell there. And that's why we've rated it as elevated. While the expected uptick in economic activity will help stabilize household debt as output incomes and interest rates rise, economic growth may not be sufficient to mitigate this vulnerability. Other policies should be used to complement economic growth to reduce the vulnerability. A range of policy responses can and have been deployed. These include the following 3 measures. First, encouraging prudence on the part of borrowers and lenders. Through the Financial System Review and other public communications, the bank has informed households and lending institutions of its analysis. Raising awareness of high household debt is intended to encourage them to exercise appropriate caution. Other public authorities have also contributed to this effort. Second, strengthening regulation and supervision of the financial sector. As I noted earlier, financial institutions and markets in Canada were relatively well regulated and supervised before the global financial crisis. Since then, the regulatory and supervisory framework has been further enhanced. The bank, along with other public authorities, has helped to develop more rigorous global standards and promote their implementation in Canada. Consequently, Canadian banks are now in better position to cope with unexpected downturns in economic activity. The third policy response is adopting macroprudential measures. These are policies that have a broad impact and are aimed at reducing systemic vulnerabilities and risks. An example of a macroprudential policy is raising minimum down payments on mortgages. In the immediate aftermath of the crisis, household debt and house prices resumed growing faster than disposable income in response to lower interest rates and the recovering Canadian economy. The federal government and a number of agencies worked together to mitigate this growing systemic vulnerability. The bank's analysis of these vulnerabilities helped to inform these decisions. For example, the federal government tightened rules for government-supported mortgage insurance 4 times over 5 years, starting in 2008. In December of 2015, the federal government made a 5th change, increasing the minimum down payment for houses valued at from $500,000 to $1 million. For its part, the Office of the Superintendent of Financial Institutions released new guidelines on mortgage underwriting and mortgage insurance that implemented enhanced global standards. These measures help to limit access to borrowing to the most creditworthy households, for example, those with higher credit scores. Thus, these policies complement the bank's stimulative monetary policy by better targeting the stimulus to those households with the capacity to borrow. Finally, with respect to monetary policy, it's important to keep its focus on our 2% inflation objective. Since the crisis, the bank has kept its policy interest rate relatively low by historical standards. It did so to support economic growth and thereby achieve our primary goal of returning inflation to target within a reasonable time frame. Because we conduct monetary policy within a risk management framework, we recognize that elevated household debt could represent a risk to financial stability. Although we have the flexibility to choose a different path for interest rates to restrain the accumulation of household debt and mitigate vulnerabilities in the financial system, we've maintained our focus on the inflation target. We believe that there are other measures, such as the macroprudential policies I just mentioned, that are better suited to targeting and reducing these vulnerabilities than monetary policy. Monetary policy affects activity in many sectors of the economy and thus is a very blunt instrument to address financial vulnerabilities. To summarize my main points, the financial vulnerability associated with elevated household debt has increased over the last decade. It has done so in part because the debt has become more concentrated in highly leveraged households, especially those who may be more vulnerable to an economic downturn. Therefore, our assessment of this vulnerability depends not only on the magnitude of household debt, but also on its distribution. However, our financial system is very resilient and could withstand the triggering of this vulnerability. And public authorities in Canada have taken measures to mitigate it. Moreover, this vulnerability should stabilize as the economy and household income strengthen and interest rates normalize. Nonetheless, the bank remains concerned about high household debt and will continue to monitor it closely. Allow me to repeat that brief summary in French for the media. Permettez-moi de résumer mes principaux points. Il y a une vulnérabilité financière liée à l'endettement élevé des ménages. Cette vulnérabilité a augmenté au cours de la dernière décennie. Cette situation tient en partie au fait que la dette s'est concentrée davantage parmi les ménages très endettés. Par conséquent, notre évaluation de cette vulnérabilité dépend non seulement de l'ampleur de la dette des ménages, mais aussi de sa répartition. Notre système financier est toutefois très résilient. Ainsi, il pourrait résister à l'interaction d'événements déclencheurs avec cette vulnérabilité. Les autorités publiques canadiennes ont d'ailleurs adopté des mesures d'atténuation à cet égard. Malgré tout, la banque se préoccupe de l'endettement élevé des ménages et continuera de surveiller la situation de près. On that note, let me conclude. The bank's mandate is to promote the economic and financial welfare of Canada. Those who established the Bank of Canada in the wake of the Great Depression in the 1930s clearly understood the two goals of financial and economic stability must go hand in hand. One is a necessary condition for the other. But the experience of history tells us that economic stability, supported by the appropriate monetary policy to achieve low and stable inflation, is not sufficient for financial stability. That was an important lesson taught by the global financial crises of the late 1920s and 2000s. Other policies are needed to safeguard financial stability. These include effective regulation supervision of the financial system and close monitoring and timely remediation of emerging financial vulnerabilities. The Bank of Canada makes important contributions to these other means of achieving financial stability. First, we use our system-wide perspective and our new framework to identify and assess vulnerabilities and risks. This helps us to connect the dots within the financial system and with the real economy. Second, we work collaboratively with our partner agencies. This has helped Canada achieve a remarkable period of financial stability over the past quarter century. This collective effort to monitor and mitigate financial vulnerabilities, such as elevated household indebtedness, is essential to maintaining a stable and efficient financial system and promoting economic growth in Canada. Thank you very much for your attention.
Okay, we have the opportunity for some Q&A. We have roving Mike, just put up your hand and we'll kick it off. But perhaps as you ponder, I'll kick us off with the first Q&A. So, fantastic speech.
Oh, thank you.
I think one of the things that is of great interest is while there are these vulnerabilities in Canada, how do we compare when it comes to the vulnerabilities in other parts of the world? And when you speak with other central bankers or your counterparts, how do our risks compare?
Well, our risks and vulnerabilities are generally much lower. I think the interesting comparison that I made in the speech is with respect to the United States just before the crisis. And you can see from the analysis that we've done, we're much, the level of vulnerability and the level of risk is much lower than it was at that time. And if you look at other jurisdictions, I think it's similarly true that we have a very good framework for financial regulation and supervision in Canada and general oversight of the financial system, and I think that's served us well in Canada. And so, despite our concerns about elevated household indebtedness, I think we're in much better shape than we are in Canada than in other jurisdictions. And you can look at other comparable countries like Australia and some of the Scandinavian countries, and they have levels of household debt that are much higher than those in Canada. And so we're in relatively good shape.
Comforting, very comforting to know. So, questions? We've got one over here. As we get the mic over there, I will ask a second one. Okay. So, are there specific policy tools that we use that have given us the capacity to manage our risk better than other jurisdictions?
Well, I think in Canada we have had a remarkable history of cooperation amongst the partner agencies that are responsible for the financial system. And as I mentioned the bank plays one role, but we work with the Department of Finance, we work with the Superintendent of Financial Institutions, and together we identify vulnerabilities, we try to assess them, and we collectively, make decisions as to what the appropriate measures are to mitigate them. So I think we have a quite an effective mechanism within Canada to address those types of vulnerabilities.
Thanks. Question over here in the middle.
Sure. Hi, Dave Hobson, University of Guelph. There's a lot of innovation going on right now in the fintech space, so financial technologies, e-banking, and we have a traditional banking structure in Canada with a lot of, let's say, old technology. Mm-hmm. What is the opportunity, or how significant is it that we're going to have disruptive innovation or just disruption of our existing banking infrastructure? And what role is the Bank of Canada going to have in regulating that?
Just to be clear, we're not responsible for regulating the banks. I mean, the one role we are responsible is for regulating systemically important payment systems. And in that regard, we are working with the banks to upgrade the payment systems in Canada, in particular the large value payment system. And there's another system that focuses on smaller value but higher volume payments. And both of those systems are in the process of being modernized, and that process is ongoing. And the large Canadian banks are important partners in that effort. And the desire is to modernize, to take on board new technologies to address, there are new technologies you've mentioned, to address those. And essentially what happens is if the technology that we use for payments does not evolve with the available technology, other disruptors will use that technology. And so it's important that we take on board that technology in the core systems of the financial system that we have now. And so that's where a lot of the effort is being directed at this point.
Well, one question over here from one of our soon-to-be graduates. We've got time for one more. I see one in the back. Okay, great. Nicholas.
Hi, so Nicholas Singh, student at the University of Guelph. First of all, I want to thank you on behalf of the students here for coming out. I mean, you just being here and spending the time really underscores the fact that we're in the right place at the right time, and I think that, among all things, means so much more than you think. That being said, my question for you is simple. Being a 20-year-old graduating university in about a year and a half, what would your recommendation be, seeing as a state of our actual housing market is the way it is? And what would you suggest, looking at it from a perspective of my eyes, being the people who hold the most debt and are most vulnerable to not paying it back? And what should we expect as students coming out into this kind of economy?
Good question. The question sort of takes me well beyond the realm of what the Bank of Canada normally does. Our purpose really, when we think of the bank's two core functions, it's really monetary policy and financial stability. And with respect to monetary policy, our objective is low and stable inflation. And we view that objective as the main contribution we can make to a growing Canadian economy. And so I think the important thing for new people graduating from university at this point is to be comforted by the fact that you do have a central bank that is committed to low and stable inflation, because ultimately that's going to create employment and output for the Canadian and growth in the Canadian economy. I think that's the other thing too, is we do play, as I mentioned, a role with the other the other agencies in the public sphere to oversee the financial system. And so again, when you look at the history of, for example, mortgage finance in Canada, it's been remarkably stable over the last 25 years. Even during the worst part of the crisis, most households were able to, if they had the sufficient down payment, were able to borrow and buy a house. So I think those two functions are really serving young people well, because they will have a bright future knowing that the economy and the financial system in Canada are well overseen.
Great. Last question in the back.
Hi there, my name is Rashawn from KPMG. Thank you, Kithio, for the invite. This is a fantastic event, and it's amazing to be in a room which what I consider as among the most financially literate. And as a great segue into the conversation and from the previous question, you know, I'm 29 and I would be considered 5 years out from University of Guelph. And in that realm of adding to the 720,000 households and higher risk demographic of the 4 billion in debt that we're considering a vulnerability. So is the question an emotional question in the sense that is it at home or is it in schools that we have to now advocate and discuss with children financial literacy? Because is the question, do we rent versus buy? How long do we stay at our parents' home? And then at the end of the day, if the parents feel that they can take equity out of their home to give us the down payment, you know, these are self-propagating issues. So where do we start advocating for our kids and helping them increase their financial literacy?
Well, we do have a number of agencies, both at the provincial and federal levels, that are aimed at sort of increasing financial literacy. At the federal level, it's the Financial Consumer Association of Canada. Their mandate is really to help consumers make the right financial decisions. But also, I think, you know, the financial institutions themselves can advise individuals or households how much risk they should take on. I mean, I think it's a co-responsibility of the institution that's lending the money as well as the person borrowing it. And I think the institution has a responsibility to make wise and prudent decisions also. So I think there's a number of sources of information that borrowers can seek out to find the information they need to make wise borrowing or investment decisions.
Fantastic. Please give a round of applause for our keynote